Cash value life insurance is either the greatest retirement tool nobody talks about, or it's a giant ripoff designed to enrich insurance agents. Depending on which corner of the internet you find yourself in, both of those positions are argued with complete conviction and very loudly. So today, we're going to do something that's become weirdly rare online. We're going to look at this honestly. Not from a sales angle, not from a buy term and invest the difference angle, just the actual merits, the actual trade-offs, and we're going to answer who this product is genuinely a fit for. Hi, I'm Brandon with the Insurance Pro Blog. We've been publishing articles and podcasting on this topic for well over a decade, and here's something that probably surprises people who find us for the very first time. We're not fanboys of any particular product. We sell cash value life insurance, yes, that's true, but we also sell term life insurance. We see the value in all the angles, from buy whole life versus buy indexed universal life insurance versus don't buy any of it. That neutrality is unusual in this industry, and I think it's the only honest place to start a conversation like this one. Because the truth about cash value life insurance is, it's not a miracle, nor is it a scam. It's more nuanced than either of those camps will ever admit. So let's get into it. When people argue about whether cash value life insurance is worth it, they're almost always arguing about one specific piece of it: the cash value, the rate of return of the cash buildup of the life insurance policy. Those who need permanent death benefit tend to be a different story in a different situation with far less arguments. But the opposition's stance on cash value, it goes something like this. Whole life and indexed universal life are mediocre places to grow money. You'd do better buying term life insurance and investing the difference in premium cost in a low-cost index fund, because over the long run, the stock market will outperform the cash value in a policy. Now, you'd expect an insurance agent like me to have issue with this, but I don't. We don't disagree with that. If you put $1 into a passive S&P 500 index fund and $1 into cash value life insurance, be it whole life or indexed universal life insurance, we bet that after 30 to 40 years, you will have more money accumulated in raw rate of return with the S&P 500 index fund. Even a more actively managed equity fund, which tends to lag an index fund, we still think would do better than cash value life insurance when it comes to raw rate of return. That's not the debate. The debate is whether raw rate of return is the only thing that matters when we're building a retirement portfolio, and we believe it absolutely is not. The first thing that cash value life insurance brings to the table that you cannot replicate inside a brokerage account, an IRA, or a 401k is its tax treatment. And I want to be very specific here, because this gets misrepresented a lot in both directions. Cash value life insurance gives you 3 tax characteristics simultaneously in one product. You get tax-deferred growth of the cash value. You get tax-free access to the money during your lifetime through withdrawals to basis and then policy loans. And you get an income tax-free death benefit paid out to your beneficiaries. These are not marketing claims. These are sections of the Internal Revenue Code. They exist. They're not up for negotiation. They're not up for debate. And they are extraordinarily valuable because they're not easy to replicate anywhere else. Think about what happens when you hold a regular taxable brokerage account. You owe capital gains tax when you sell. You owe ordinary income taxes on the dividends and interest that is earned each and every single year. A deductible retirement account also carries a very large tax liability. Every year, there's a drag on your return that doesn't exist inside a life insurance policy. And the higher your effective tax rate, which tends to be the case for higher income earners, especially people in high income tax states, the more the gap between the taxable account and the cash value life insurance account starts to converge. In some cases, the after-tax net of everything return on a well-designed whole life policy ends up competitively with a taxable equity portfolio, not because the policy beat the market, but because the market's return got taxed down to a result that's closer to the life insurance policy. That's a real thing. It's not a sales pitch, it's arithmetic. The second thing cash value life insurance brings to the table is something most people never think about until it's too late to act. And it might actually be more important than the tax treatment. It's the fact that cash value life insurance is a genuinely non-correlated asset. Non-correlated just means it doesn't move with the other investments in the stock market. And when you're building a retirement portfolio, that's a feature you really want. especially for the portion of your money that needs to be there when things get really ugly. For decades, traditional financial advice handled this problem by thinking that stocks and bonds move in opposite directions, so when stocks go down, bonds will hold you up. And for quite some time, that theoretical construct remained pretty much untested. But we've known since the early 2000s that the correlation between stocks and bonds has been converging. They're starting to move closer together a lot more often than traditional textbooks had suggested they would. Meaning, when stocks go down, bonds might also go down with them. And in 2022, that's exactly what happened. The S&P 500 was down roughly 18% for the year. The Bloomberg US Aggregate Bond Index was also down roughly 13% in that year. If you were running a textbook 60-40 portfolio, there was nowhere to hide. Both asset classes fell together by a lot. That's a real problem if you happen to be retired or you're about to retire. Now, people do look at other options, gold, crypto, commodities, and those have their own issues. They tend to be volatile in ways that make them extremely hard to time and difficult for people to hold on to long term. People who have done well with gold and crypto are mostly those who bought in very, very early and held for decades, not people who tried to rotate in and out of them as a substitution to stocks when the market got really scary. That's a skill that pretty much nobody has. And none of those assets have proven to be, in fact, non-correlated, moving in opposite directions to the US stock market when it's falling. Whole life insurance and index universal life insurance are different. They're contractually structured in a way that removes correlation with the broader market. Not reduces it, removes it. Whole life, in particular, is guaranteed to grow every single year. The cash value goes up contractually, and historically, it's been augmented by a dividend on top of the guaranteed accumulation of cash. The market can do whatever it wants, and whole life cash value just continues climbing. Index universal life insurance is a little different. It credits interest based on the performance of a market index, and usually this is the S&P 500, but with a zero floor. So if the index drops, let's say 20% in a year, you don't lose money in index universal life insurance in the same fashion you do being invested in the market. You just sit flat, you don't earn any interest. And here's the part that people miss. After a bad market, there tends to be a bounce back, a resurgence. The markets revert towards the mean. So when the S&P 500 rips 25% following a down year, an index universal life insurance credits a very strong interest rate in most cases. And because you didn't lose anything the year prior, you're compounding off a higher base. Over time, this asymmetric profile can produce returns that look nothing like a straight-line stock market investment. The real power of a non-correlated asset shows up during the bad times, which is exactly when most of your other holdings can't help you. If everything you own is tightly correlated with the stock market and the stock market drops 30% the year you retire, you have nowhere to turn. You sell assets at a loss to generate income, which is the single fastest way to run out of money in retirement. And you probably make some panicked emotional decisions that look foolish in hindsight, but made perfect sense in the moment. But if you're holding a non-correlated asset, something you can lean on while your equity portfolio recovers, you buy yourself time. And time in that moment is the most valuable thing you have. This isn't theoretical. Wade Pfau, one of the most respected retirement researchers in the country, published work in the Journal of Financial Planning showing that using whole life insurance cash values as a volatility buffer during the first years of retirement can meaningfully improve both spending sustainability and legacy outcomes. Separately, Ibbotson Associates, which is part of Morningstar, has done work showing that incorporating permanent life insurance cash values into a diversified portfolio can increase risk-adjusted returns and reduce portfolio standard deviation. This is what the opposition position tends to completely miss. When you build your case against cash value life insurance on a spreadsheet, where declines are just a momentary blip in the course of time, it makes perfect sense that the product looks inferior. But retirement doesn't happen on a spreadsheet. It happens in real life, where a 30% drawdown in year 2 of retirement is a genuine crisis. Cash value life insurance can help you avoid that crisis. Okay, so cash value life insurance has real, legitimate, evidence-backed advantages. Does that mean everyone should own some? No, it does not. And this is where we part ways with a lot of agents in the insurance industry. Cash value life insurance is a fit for a specific kind of person. Let me describe them. First, they're higher income earners who have already put the foundation of their financial life in place. That usually means they're contributing to their 401k at least up to the employer match. They have funded an IRA or Roth IRA. They're not carrying high-interest consumer debt, and they have an emergency fund. These people do not need cash value life insurance to become wealthy. They're already well on their way. What cash value life insurance does for them is materially improve the risk profile of their retirement plan. It adds diversification. It adds a hedge against sequence of returns risk. It adds a tax-advantaged income source that won't show up on their 1040. Second, there are people with a capacity to fund the policy for the long haul. Cash value life insurance needs time to work. The early years are not impressive. The cash value in years 1 through 5 is going to overwhelm almost anyone. This is a 10-year plus commitment at a minimum, and ideally longer. Now, a properly designed policy has some flexibility in the premium. You're not completely locked in, but if you cannot comfortably see yourself paying the planned premium for at least a decade, this probably isn't the right move for you. The one exception to this statement is somebody who's already sitting on a significant lump sum of money, maybe from an inheritance, a business sale, liquidity event, and wants to reposition some of it into a limited pay structure life insurance policy. That's a different conversation with a different set of rules, so the 10-year funding commitment isn't a requirement. Third, people who actually need or want the death benefit. This is the part that gets glossed over in almost every pro-cash value argument online. It is life insurance. There has to be a reason you want the life insurance part. If you have a spouse, children, a business partner, a legacy goal, an estate planning concern, that's all great. That's a reason to own the policy because you need the life insurance that it provides, beyond just the cash value. This is a relatively liberal definition of need for life insurance. So if none of these situations apply to you at all, you're not a candidate and you shouldn't do it. Now let's talk about who additionally should not be buying this product, because I think oversells in this space have done just as much damage as the buy term and invest the difference crowd. If you're earning under $100,000 a year and the rest of your financial life is not squared away, cash value life insurance is out of order. If your 401k isn't getting the full match, if your IRA isn't funded at all, if you're carrying consumer credit card debt, buying whole life insurance to get ahead financially isn't going to make things any better for you. The statistical likelihood that something in your broader financial life goes sideways and forces you to lapse the policy you've only had for a few years, it's really high. And a lapsed policy in the first several years is one of the worst financial outcomes in this entire conversation because you will likely get back less money than you put in. Next, if you're being sold on a single, narrow reason, be very, very careful. The most common version of this right now is tax rates are going to go to the moon, so you need a huge whole life policy to shelter your retirement from future taxes. We've heard this hundreds of times, and here's the issue we take with it. It's not that future tax rates aren't a legitimate concern. They are. It's that when an agent hammers on one single emotional talking point, it's often because they don't want you paying any attention to the rest of the policy. Whether it's designed correctly, the cash value is optimized versus the agent's commissions, a different product might fit better, or it even makes sense financially for you. Tax talk gets people riled up, and riled up buyers don't ask enough of the right questions. If someone is selling you a policy and the entire pitch collapses into a single fear, be it taxes, inflation, market crash, whatever, that's a sign to slow down, not speed up. And also keep in mind that most of the cash value life insurance horror stories that you hear about are execution errors, not product errors. This is really important. People who bought a policy and were devastatingly disappointed in it 15 years later, the overwhelming majority of those stories trace back to the wrong product being sold, the wrong design being used, or an agent who inflated the illustrated returns to get the sale. That doesn't mean cash value life insurance is fraudulent. It means somebody was sold the wrong thing, built on the wrong expectations by somebody whose interests weren't fully aligned with theirs. There's a huge difference between a bad product and a badly implemented product. And the distinction matters. Because if you throw out the whole category because of bad execution, you're throwing out a genuinely useful tool for a lot of people. So, is cash value life insurance actually worth it? For the right person, designed correctly, held for the right length of time with expectations grounded in reality, yes, it offers a stable, predictable rate of return, a set of tax features you cannot get anywhere else in one product, and a genuinely non-correlated asset you can lean on in moments when your other investments can't help you. For the wrong person, or the right person with the wrong design, Or somebody coming into it expecting S&P 500 returns without the risk? No, it's going to disappoint you. At its very best, it's a complement to your broader portfolio. It's not the whole portfolio. It's not the answer to every financial problem. And anybody who tells you that it is should be viewed with extreme skepticism. But it's also not the scam that corner of the internet insists it is. It's a tool, a specific tool, for specific people, solving specific problems. The goal of this channel, and the Insurance Pro blog more broadly, has always been the same: educating first, selling second. If this video helped you see the trade-offs more clearly, regardless of which direction you ultimately go, then it did exactly what it was supposed to do. Now, if you want to know where you actually fall on this spectrum of whether you're a strong candidate for cash value life insurance or a weak candidate for cash value life insurance, or just somewhere in between, we built a tool to help you discern exactly that. It's a questionnaire on the Insurance Pro blog website. You answer it on your own, no phone call, no sales pressure, no email drip campaign afterwards. You get an analysis back that tells you honestly how good of a fit you are for cash value life insurance. You can even download your results and keep them. And I recommend you do, because if you decide you want to reach out to us afterwards to talk about the possibility of buying a policy, we can use your results to cut down on some of the data collection. We don't save any of the questionnaire entries, so we're going to need your saved results. If the answer is not a fit, we'll tell you. We'd rather tell you that up front than waste your time. I'll drop a link to the assessment in the description below. If you'd rather just have a conversation about whether any of this fits your situation, there's also a link to schedule time for a call with us. No obligation, no sales pitch, just a straightforward conversation. If you got something out of this video, the single most helpful thing you can do for the channel is leave a comment below with your reaction. Agreement, disagreement, question, whatever. It helps more people find videos like this one. And if you want to go deeper on any of the topics we touched on today, the tax treatment, the volatility buffer research, how to tell if a policy is designed correctly, there are hundreds of articles on all of these subjects at theinsuranceproblog.com. Thanks for watching, and we'll see you next time.